Hi, this is Peter from Game of Trades, and I'm here to help you navigate through this stock market. It is truly an amazing time to be in the stock market. There are some amazing moves happening right now. So if you want to be a part of this, make sure to subscribe if you haven't already. And without further ado, let's get right into it. So in the last video, we talked about the relationship between gold and interest rates, and we saw something that was a little bit worrying. We saw that gold was potentially telling us that we are experiencing harsh economic conditions right now that are going to show up in the stock market at one point in the near future. So we're going to talk about that in more detail in this video. We're going to go back to examples in 2008, 2018, 2006, right? All those harsh economic conditions. And we're going to see what gold was telling us throughout those times to see if it's somewhat similar to what we're seeing right now. So we're going to start off with a quick market update on the S&P 500, see what the technicals are telling us before we dive into the macro picture. So in terms of price action, the S&P 500 is looking very bullish, right? We're coming out of this consolidation, this multi-week consolidation on the S&P 500. And this is textbook just working off the overbought conditions for another leg up, right? We have a leg up, consolidation, and then another leg up. So from a very simple standpoint, this is bullish. Now we had a trade going from the bottom here in October, right before the election. This was an official trade setup that we posted on GameOfTrades.net, and we re-entered on that trade when we backtested that consolidation pattern. So we traded that breakout, had that backtest, re-entered right here. There was another official trade on Game of Trades, and so far we're riding the rest of that move up, booking profits along the way. Now that's from a purely price action standpoint. It's looking bullish and we are positioned long, and we're ready for this uptrend to actually potentially accelerate in a blow off top move, very similar to what we had here, very similar to what we had here. And you'll notice that's a pattern we're seeing every time on this uptrend, on this rally, every time we have a breakout. So we had this consolidation right here. We had a breakout here. It starts off slow and then it accelerates into a big top. Again, same thing here. We had a consolidation, breakout, backtest, starts off slow, and then an acceleration into that blow off top move. Doesn't mean the same thing's going to happen, right? But it is definitely a possible scenario, and it is something that we are currently positioned for to the long side. And if that doesn't happen, if the trade goes against us, if we have a big bank that goes bankrupt or a wave of insolvencies in the retail sector, which is something that's very likely to happen in the next few weeks, few months, then we're going to get stopped out of our trade. And our long-term investment portfolio will not be affected because we're completely out of stocks, right? We're staying away from stocks long-term. We've said this over the past few months, few years. In fact, we've been positioned in gold, not stocks, because stocks are overvalued. Gold's undervalued. We're positioned in crypto. We started accumulating Bitcoin very early on. At the beginning of October, we talked about the Bitcoin bull market. So in general, we're looking to profit from the S&P 500 short term, but we're staying away from it in the longer term. We think there's better opportunities out there than stocks. Can they continue going up? Yes. Is that something we're willing to risk? No. And by the way, if you're interested in all these opportunities that we see long term for our investment portfolio, make sure to go check out GameOfTrades.net. We post articles on trading and investing, right? Two very different things, and it's very important to make that difference. So we covered the S&P 500 from a technical standpoint. From a price action standpoint, it's looking bullish. But now let's take a look at the put call ratio, and that is something to be worried about. The put call ratio is currently sitting at a very low level, very close to extreme low in what we saw in June and August. And I'll say this again and again, and this is extremely important. This is not a sell signal on its own. It just means that there is risk in the market. And that if the market goes down, let's say based on news, or there's a big sell-off because of a technical breakdown, you're likely to get a big snapback in the stock market. And that's because everyone's positioned long on calls and they have to sell their calls, creating even more selling pressure on that move down. So seeing this ratio extremely low, is it worrying? A little bit, right? It's not good to see, but it can stay extended like this for extended periods of time. That's something we saw during the month of July and August. And by the way, for those of you who don't know what we use the put call ratio for, it's an indicator that's useful at extremes. So this was the bottom of the March crash. So if you went against this reading, you bought calls when everyone was buying puts, then you would have done very well. And same thing the other way around. In June, you bought puts instead of buying calls like everyone else, you would have done very well. But we can compare that with the S&P 500. And again, you'll see this entire rally right there, big gains on the S&P 500 were made when the put call ratio was extended. And it's only when we had that technical breakdown that you had that big snapback. The day we get that sell signal, and we're going to have to follow that, we're going to be following the price action every day, looking for that sell signal. When it comes, there's likely to be a big snapback. And that's something we're calling for, right? A blow off top move and then a big snapback that catches everyone off guard. So we're really glad to have caught this trade from the very beginning and not to have to enter now that the put call ratio is at an extreme low, right? We're just keeping our position. We're just holding our position right now. We're not entering anything new with the put call ratio at extreme levels like this. Now let's move on to the gold versus interest rates analysis, a little bit of macro. Before we do so, make sure to click that like button if you're so far enjoying this video. Quick wrap up of the markets and then deep dive into the macros. And by the way, leave a comment below if you enjoy macro analysis. I'm going to leave a link in the description below of a macro channel that we stumbled upon that was covering this relationship between gold and interest rates. And frankly, it gave us a lot of answers. And we're going to start from the beginning. We're going to go to the chart of the dollar, and I'm going to explain to you why we were a little bit worried at what was happening on gold. So this is a chart of the DXY, so the US dollar currency index, right? You can see this technical picture, beautiful uptrend with a nice trend line, multiple reactions along the way. And then you have a classic, this was one of our posts on gameoftrades.net, classic breakdown, backtest, and rejection, right? It couldn't be more clear. And this is why we were expecting more downside on the dollar, right? And it was also based on just the fact that we had the first round of stimulus talks and then the second round of stimulus talks for that second leg down in the dollar. Now, what's worrying about this chart is that throughout this downtrend in the dollar, right, we'll put a daily chart so that we can zoom in a little bit. This is the original downtrend, right, throughout the beginning of 2020 in the dollar, and we can put gold on top of that to see how it behaved. And you can see throughout that downtrend in the dollar, gold went up massively, right? And that's something that makes sense. These are assets in competition, gold versus currency. So when one does bad, the other does well. Now, the problem comes when we had this big downtrend in the dollar, rejection and downtrend. So that's a big leg down in the dollar, but gold throughout that entire time was trending down as well. So you had the dollar going down, gold going down. Why was that happening? So there are a couple of explanations for that. One of them is that with the vaccine news, gold is going to underperform now that uncertainty has now decreased, which is an argument that makes sense. But we think it's a little bit more than that. Gold really should be trending up when we're talking about stimulus, when we're talking about devaluation of the currency, right? They're talking about a massive increase in the supply of US dollars. Gold should be going up regardless of vaccine news. And so what we believe is happening in gold right now is that it's telling us that economic conditions are harsh right now, that there's less money flowing around and less investors able to flood into gold and buy gold. And that may sound a little bit of a stretch, but sometimes the best analysis comes with this type of correlation. And we're going to go back to 2006, 2008, and 2018 and see this correlation and exactly how it works. And then we're going to talk about how we can prepare ourselves for that. So I've jumped to a weekly chart of gold. This is the beginning of the bull market on gold. We posted a video here, phase 2 of the bull market, right? This has been our long-term investment strategy from the beginning. Now let's go back and see to 2006. And this is probably something that none of you have ever seen before on YouTube. I don't think there's analysis like this on YouTube. The real beginning of the financial crisis started in 2006. And that was the bursting of the housing bubble. And I can show you a chart of the home builders to show you that that's the case, right? Home builders bubble topped end of 2005, beginning of 2006. And that was the massive downtrend in the home builders and housing prices. So the real causes of the recession started much before the actual financial crisis. This was 2008. This was gold during the financial crisis. We're going to talk about that in just a second. So let's see what gold did throughout 2006 in response to this bursting of the housing bubble. So we're going to remove the home builders, and we can see gold got absolutely destroyed here from top to bottom. That was a massive 25% correction. And that was a massive period of consolidation on gold. It didn't really start an uptrend until 2007, right? So that was telling you that economic conditions were difficult throughout that time. And we can see what was happening on the dollar at that time. And it was going down. So same thing that we have in 2020. We have the dollar going down. This is the dollar. And we have gold going down as well. So that makes absolutely no sense unless you think about the fact that these were harsh economic conditions for investors. So let's see what happened to the stock market at the end of this consolidation, right? Because this is a predictive relationship. That's very important to understand. So the end of the consolidation marks the beginning of the consequences in the stock market. So let's put the stock market, the S&P 500 above, and you can see the end of that consolidation marked the top of the 2008 bull market, right? And then it started a slow downtrend. So this consolidation started that downtrend in the stock market. Now let's move on to 2008. This is the financial crisis. Housing bubble, financial crisis. Two separate but very related events. We had gold, again, same thing, go down throughout this period, right? And I'm not taking this last part because this was the liquidity crisis, right? You can see this was the liquidity crisis, and that's exactly what we want to avoid. We want to avoid the liquidity crisis. So this is what we could have used to predict the stock market with gold. Gold going down from top to the bottom. That's another 25% drop in gold, and the end of that move down, that final move down, right before the Lehman Brothers collapsed, right before they went bankrupt, we had this massive financial crisis. So gold told us that economic conditions were harsh during the housing crisis and that they were harsh during the financial crisis, before the stock market started to go down. There isn't any significant drop since 2008. So we're going to go back to 2018, right? And let's see what happened to gold before 2018. And a quick lesson here, this crash in 2018 was caused by quantitative tightening. The Federal Reserve decided to start tightening their policy. And so instead of doing QE like they were throughout the entire bull market, they started actually reducing the size of their balance sheet. And that started to create some problems in the economy. And guess what we could have used to tell us that economic conditions were harsh? Well, gold. Look at gold throughout this period. In 2018, gold was going down. Gold was going down, telling us that economic conditions were harsh. And at the end of that downtrend in gold, we had the top of the market in 2018, and then we had a big drop in the stock market from the top to the bottom. That was a almost 20% drop in the stock market. So that's telling us right now in gold, it's telling us that there's something going on in the background right now. Economic conditions are not easy. They are hard, and that's not much of a surprise after what the economy has been through. We've been expecting, we've been waiting for an insolvency crisis, and this is one of the early signs that it's coming, that we're going to be seeing insolvencies in the next few weeks, in the next few months. But until then, stock market is still going to rise. It's still going to be going up, especially if the dollar continues its downtrend, right? And that's what the stock market does. It makes a big run up on the final move up, traps people at the top, and then dumps all the way down. And we intend on making profits all the way to the top. We'll be trying to exit at the right time, and then hopefully we'll be able to start shorting the market at the right time when we see the right technical breakdowns in the charts. Right now is not the time for that, but when it comes, we'll be ready. Like we managed to short the markets in March, we'll be able to short them again. So that's about all I wanted to cover in this video. If you enjoyed, make sure to drop a like and subscribe to the channel if you haven't already. In the meantime, good luck on your trading and see you next time.
So, you want to invest in the cryptocurrency market, but you don't know where to start? Welcome to the Covesting module on PrimeXBT. The Covesting module helps investors and talented cryptocurrency traders find each other. With an easy-to-use interface, you can compare and replicate successful strategies with a proven track record. You can follow multiple trading strategies to diversify your risk. Covesting module on PrimeXBT. They trade, you profit.